So let's talk about this book, The Intelligent Investor. It was written by Benjamin Graham way back in 1949. I mean, think about that for a second. That's over 70 years ago. In a world of crypto, high-speed algorithms, and meme stocks flying to the moon, can this ancient book really hold the key to success? Or is it just a financial relic? Well, we're about to find out.
I mean, you've got Warren Buffett, maybe the greatest investor of all time, who calls this the best book on investing, period. And yet, if you really dig in, so many of its core ideas feel, well, they feel completely wrong for today's market, right? So that's what we're going to do. We're putting it to the test. Graham's timeless wisdom versus today's brutal, high-speed reality.
All right, round one. We're starting with Graham's most famous idea. And what he wants you to do is forget all the complicated charts, forget all the algorithms for just a minute, and instead, picture the entire stock market as one single, totally unstable person.
Meet Mr. Market. He's your business partner. And every single day, without fail, he shows up and names a price. Some days he is absolutely flying high. He's euphoric, and he'll offer you a ridiculous amount of money for your shares. But then other days, he's a total wreck, completely terrified, and he'll practically give you his shares for pennies. And here's the ticker. His price has nothing to do with the actual value of the business. It's all about his wild, crazy emotions.
And this isn't just some theory. Just look at this real-world example. It's March of 2000. Mr. Market is feeling great. He's offering you $2,600 for one share. Okay, now fast forward just 1 year. The company's actually doing better, it's more profitable, but Mr. Market, he's having a full-blown panic attack. And now he says that exact same share is only worth $500. So you gotta ask yourself, why in the world would you ever let this guy, this emotional mess, dictate your financial future?
Okay, I can hear you now. But wait, that was ages ago, right? That all made sense when news traveled by horse and buggy. But today, we have instant data, non-stop news, analysis everywhere. Surely Mr. Market is a bit more rational now, right?
Yeah, you'd think so, but not really. See, back in Graham's day, Mr. Market showed up once a day in the morning paper. You could look at his offer, think about it, and then get on with your life. But today? Oh man. Today, he's a push notification on your phone. He's a breaking news alert. He's that little ticker in your pocket just screaming for your attention literally 100 times a day. If anything, his mood swings are just faster and way more intense.
And this is where Graham's genius really shines through. His solution is timeless. You have to ignore the noise. Remember, a stock isn't just a flickering price on a screen. It's a tiny piece of a real business with real buildings, real products, real earnings. Your job isn't to play psychiatrist and guess Mr. Market's mood. No, your job is to use his manic episodes against him. You buy from him when he's scared out of his mind, and you sell to him when he's irrationally greedy. See the difference? You're the one in control, not him.
All right, so let's say you've got it. You've learned to tune out Mr. Market's daily drama. What's next? Well, that brings us to round two. Graham says you have to make a choice. You have to decide what kind of investor you're really going to be. And for him, there are really only two options. Okay, so on one side of the ring, you've got the defensive investor. Their main goal is super simple. Play it safe, avoid big, stupid mistakes. They want a simple, rules-based system that doesn't require a ton of effort. Then, on the other side, you've got the enterprising investor. This is the active player. This is the person who's willing to roll up their sleeves, do the homework, and really try to beat the market.
But hold on a second. Isn't that the whole point of investing? To be enterprising? I mean, aren't we all trying to find the next big thing? The next Google, the next Amazon before anyone else? Isn't the goal to chase those massive, life-changing home runs?
Well, that kind of thinking gets dangerous fast. Take a look at this quote. This is from a real mutual fund strategist right at the peak of the dot-com insanity. He's basically saying people were throwing out good companies just because the price was high, and that was a mistake. They got so caught up in the hype, the story, that they convinced themselves the price you paid just didn't matter anymore. And, well, we all remember how that story ended.
Graham's reaction to that kind of fuzzy logic is just, no. It's a hard no. Of course it's riskier when prices are higher. It's just common sense. A company can only make so much money, right? The profits are finite. So, the price you're willing to pay for a piece of those profits also has to be finite. It's simple. Price is what you pay. Value is what you get. Don't ever confuse the two.
Okay, so we've established the market is a psycho, and chasing hype is a really bad idea. So how do you actually survive out there? How do you thrive? This leads us to round three, and what is probably Graham's single most important golden rule.
So how do you do it? How do you build that buffer? How do you put up a real defense, not just against the market's craziness, but also against yourself, against your own mistakes? Because let's be real, you're going to be wrong sometimes. We all are.
And his answer is 3 simple words: margin of safety. This is it. This is the absolute cornerstone of his whole philosophy. It means you do the work, you figure out what a business is really worth, its intrinsic value, and then, and this is the crucial part, you insist on buying it for way, way less than that number. That gap, that discount, that's your margin of safety. That's your protection.
Here's a great way to think about it. Imagine you need to build a ship for 30 Vikings. You wouldn't build a ship that holds exactly 30, would you? Of course not. You'd build one that can hold 50. That way, if a few extra buddies decide to tag along, or you hit a monster swarm, you're not going down. You're safe. That extra space, that's your margin of safety. It's the buffer that keeps your portfolio afloat when things go sideways.
And when you start thinking this way, you see some really crazy things in the market. Check this out. This is from just a few years back. In 2018, for Apple's stock price to be justified, the company needed to grow its profits by about, let's call it 6% a year. Okay, seems reasonable. But look at Amazon. For its stock price to make any sense, it needed to grow by 74% a year every single year for a decade. So, which one of those has a bigger margin for error? Which one is pricing in perfection and which one is grounded in reality? It's pretty clear, right?
All right, time for the final round. And this is where things get really interesting, because Graham basically takes a fundamental rule of modern finance, something they teach in every university, and he turns it completely upside down.
Yeah, you know this one. We've all had it drilled into our heads. To get higher returns, you must accept higher risk. It's that chart that always goes up and to the right. You want more reward, you got to take on more risk, which they almost always define as price swings or volatility.
Okay, to see how nuts this idea can be in the real world, just imagine this. Some guy comes up to you and offers you $10,000 to play one round of Russian roulette. Now, you're a sane person, so you say no way. But then he comes back with another offer. Okay, how about $100,000 if you take 2 shots?
See? More risk, more reward. That's the academic theory in a nutshell. But does that actually make any sense? Is that really a smart trade to take?
Graham's answer is a loud, resounding no. For an intelligent investor, he says the relationship is the exact opposite. It's inverted. The less risk you take, the higher your potential reward ought to be. Now, how is that even possible? It's possible because you find an amazing business and then you wait patiently until Mr. Market has a total meltdown and offers it to you for, say, 40 cents on the dollar. That massive discount, that is what gives you a high potential return and a low risk of losing your money for good.
So, when you boil it all down, what are the big lessons from this showdown? Number 1, Mr. Market is your servant, not your master. You tell him what to do. Number 2, price is what you pay, value is what you get. Never forget that. Number 3, always, always, always insist on a margin of safety. And finally, number 4. The biggest risk you face isn't that the market will be volatile. The biggest risk is paying too high a price for something.
So Graham gives you the tools, right? He gives you the mindset, the weapons for this duel. But here's the big question for today. In a market that's this fast, this chaotic, dominated by algorithms that trade in microseconds, who really has the upper hand? Is it the patient, business-minded investor, or is it the machine? And that's the question we're left to grapple with.